Most people are losing money in the stock market and we don't even realize it. Why? Because we're overthinking, overtrading, and trying to outsmart something that doesn't need to be beaten. But what if I would tell you that the most boring strategy might be the most effective way to build wealth over time? I'm talking about none other than the low-cost ETFs that track the S&P 500. For example, VOO or SPY. No hype, no guesswork, no staring at the charts at 2 a.m. Just slow, steady growth and potentially hundreds of thousands or even millions of dollars over time. In this video, I'll show you why these ETFs are the easiest way to invest smartly and why so many people do the mistake of ignoring this strategy, even though it works. Stick around because by the end of this video, you might just rethink your entire strategy on investing. Alright, let's break it down. Why do so many investors swear by S&P 500 ETFs such as VOO and SPY? Let's look at the biggest reasons why the strategy just works and why it might be the smartest financial decision you ever make. Let's kick things off with one of the biggest hidden killers of returns: fees. Most mutual funds or active managers charge over 1% per year just for holding your money. But with ETFs like VOO, you only pay 0.03%, which basically means that for each $1,000, you would only have to pay 30 cents, compared to the $10 charged by mutual funds and active managers. And over decades, that difference can end up to be thousands more in your pocket without any extra work. Additionally, these ETFs have built-in diversification. When you buy S&P 500 ETFs, you're instantly investing in 500 of America's biggest companies. Tech, healthcare, energy, consumer goods, they're all there. If a company crashes, it barely makes a dent. That's the beauty of spreading your risk across the entire economy. Another key factor is the strong and consistent historical performance. Since its inception, the S&P 500 has returned about 10% per year on average. That includes wars, crashes, pandemics, you name it. It's not flashy, but it's one of the most reliable wealth builders ever created. And the beauty of it, you just set it and forget it. No stock picking, no charts, no endless research. With just one ETF, you're buying a slice of the whole market. You do not have to check the news every day or stress over quarterly earnings. Just invest consistently and move on with your life. It's that simple. And here's another hidden bonus. Low-cost ETFs are incredibly tax efficient. Because you're not consistently buying and selling, you're not triggering capital gains taxes every time the market twitches. You hold, you grow, and you only pay taxes when you actually cash out. It's simple and way more efficient than active trading. All that sounds great, but what does it actually do for your money? Let me show you what happens if you stop chasing hype and just let time to do the compounding and heavy lifting. Now, let's make this real. I was born in November 1992, and let's say my parents would have invested $10,000 into the S&P 500. During that period of over 30 years, the S&P 500 did over 10% annual returns. And today, that investment would have grown to $252,000, including dividends. That's over 25 times the original amount, just by buying, holding, and letting time do its thing. No stock picking, no market timing, just the power of a market and a lot of patience. Now you might be thinking, okay, good for you, but I do not have $10,000 laying around. Fair enough, most people don't. But here's the thing. You do not need it. I used another calculator to test what happens if you start with zero and just invest $100 a month. Same timeline of around 32 years, same 10% average annual return. As you can see, after all those years, you would have invested around $38,000 in total. And guess what? That slow, steady approach would have grown to $254,000, which is basically the same return as the initial 10K lump sum investment calculation. However, in this case, you do not need the money up front. It's not about getting rich quick. It's about getting rich consistently. Small steps taken early and often can lead to massive results down the line. By now, it should be pretty clear. This strategy works. It's simple, proven, and honestly kind of a no-brainer. So why, just like the like and subscribe buttons on my channel, everyone's ignoring it? Well, that's where things get interesting. It's not about math, it's about mindset. Let's talk about why most people still manage to mess this up. First, emotions take over. The market goes down and suddenly people panic. They forget the long-term plan and start thinking the world is ending. And when things go up, FOMO kicks in, and now they're chasing meme stocks or the next hot thing. Emotions are the enemy of good investing, and unfortunately, they're louder than logic. Secondly, everyone thinks they're a genius. There is this belief that I can do better than the market. And sure, some people get lucky, but most people end up underperforming the very index they're trying to beat. Here's the joke. The average investor thinks he's above average. Another issue is the fact that it simply feels boring. Let's be honest. Index investing isn't exciting. No drama, no daily thrill, no flashy wins. But you know what's exciting? Watching your net worth grow quietly year over year. If you want some excitement, you can always allocate a small portion of your portfolio to do some active investing. Finally, these days, people just want quick results. We live in a world of instant everything. Instant food, instant likes, instant results. But building wealth through ETFs takes time. And that's exactly why it works. Because most people don't have the patience to wait. Now, as much as I believe this strategy, I'm not here to tell you that it's perfect for every single person. Because there is one big caveat, and if you miss it, it could seriously mess up your plans. If you think you'll need this money soon, I'm talking in the next 5 to 10 years, then this strategy might not be your best option. Why? Because the stock market is a beast in the short term. It can go up, it can go down, and it can go sideways. It doesn't really care about your vacation plans or your down payment timeline. So if your goal is short term, like paying for a wedding or paying down tuition, then you should probably look at safer options, like high-yield savings accounts or bonds. Those won't grow your wealth as fast, but they also will not drop 20% right before you need the cash. But if you're investing for the long run, 15, 20, or even 30 years, then these short-term dips don't really matter. Historically, the longer you stay in, the better your odds of seeing strong, positive returns. It's all about matching your investment strategy to your time horizon. And if you have time, ETFs should be your best friend. Let's keep it real. Investing doesn't have to be rocket science or a full-time job. Low-cost S&P 500 ETFs give you all the power of the market, without the stress, without crazy fees, and without trying to be a Wall Street genius. You get diversification, solid returns, and the magic of compounding, all while you sleep, work, or binge your favorite show. So here's the deal. If you want to build wealth the smart and simple way, this strategy is a no-brainer. Just invest consistently, keep your emotions in check, and watch your money grow over time. Remember, the market might throw you a curveball, but patience is your superpower. Now go ahead, set it and forget it. Your future self will thank you for it. Oh, and if you're a parent, do the thing my parents didn't do for me. Start your child's investment journey now. So that's it for today's video. If you enjoyed it, please click the like and subscribe buttons and let me know in the comments what you think. And as always, guys, thank you for watching and I hope to see you in the next one. Bye.